Hello everyone and welcome back to Explain the Charts. Today is October 24th, 2025, and we're breaking down the S&P 500 ETF, symbol SPY. The market is in a fascinating spot right now, with a whirlwind of conflicting news creating a lot of uncertainty and volatility. So we're going to unpack the headlines and then dive deep into the charts to see what they're telling us. First, let's talk about the current news environment because it's a real mixed bag. On one hand, the artificial intelligence narrative remains incredibly strong, with companies like Intel and Apple seeing their stocks surge on high demand for AI chips and record iPhone sales. This has been a primary driver keeping the market near all-time highs. However, there's also a growing sense of caution among major investors, who are reportedly shifting away from the most hyped-up names. We're also seeing mixed results from corporate earnings. While Intel beat expectations, both Tesla and Netflix recently reported misses, causing dips in their share prices and weighing on market sentiment. Adding to the uncertainty, we have major macroeconomic headwinds. Fears of an escalating trade war with China are back on the table, and concerns are mounting that the ongoing U.S. government shutdown could be reaching a tipping point, potentially harming the economy. All eyes are now on the upcoming key CPI inflation report and earnings from the rest of big tech, which will be huge market-moving events. Okay, with that context, let's jump into the daily chart for SPY. Looking at the big picture since mid-2024, the primary trend has been clearly bullish, with a consistent pattern of higher highs and higher lows. The market just set a new all-time high earlier this month, right around the $673 level. Naturally, this 673 area now stands as the most critical resistance level that bulls need to break. However, this uptrend has been punctuated by periods of intense selling pressure, reminding us that nothing goes up in a straight line. To illustrate this, let's zoom in on the sharp correction we saw back in early April of this year. On the chart, you can see this dramatic drop where SPY plunged from around 560 all the way down to a low of 481 in just a matter of days. That was a swift and brutal 15% correction, fueled by intense market fears at the time. Although the market eventually recovered and marched to new highs, this serves as a powerful reminder of how quickly sentiment can turn and how severe pullbacks can be. We saw another jolt of volatility more recently, with the sharp sell-off on October 10th. Now, back on the full daily chart, let's focus on that recent price action. After touching that all-time high near 673, the market experienced a rapid pullback to a low of 653. This 653 level has since established itself as a very strong short-term support zone, with buyers stepping in aggressively. For the past couple of weeks, we've been in a recovery mode, grinding our way back up towards those highs. Yesterday's candle shows a notable pullback, which aligns perfectly with the news reports of renewed trade war fears that sent the Dow tumbling. The key question now is whether this is simply a consolidation before the next leg up, or if it's a sign of weakening momentum and a potential failure at resistance. To get a better look at this short-term battle, let's switch over to the 1-hour chart. This time frame gives us a much clearer view of the V-shaped recovery from the 653 low on October 10th. The ascent has been steady, but notice how the price action has become much choppier over the last few trading sessions. We now have a well-defined resistance area between 671 and the all-time high of 673. On the downside, a minor intraday support level has formed around the 667 to 668 area, which was yesterday's low. A break below this level would be the first sign of weakness and could lead to a test of the 663 zone. It feels like the market is coiling and building energy for a significant move, which is typical ahead of major news catalysts. Now let's drill down one last time to the 15-minute chart to examine the very latest price action. Here, we can see the anatomy of yesterday's sell-off from 672 down to that 667 to 668 support zone. Today's trading has been a slow but steady grind back upwards, attempting to recover those losses. The volume has been fairly average, suggesting that neither the bulls nor the bears have taken decisive control just yet. Right now, the price is consolidating in a very tight range, which screams indecision. It's clear that traders are on the sidelines, waiting for those crucial earnings reports and economic data before making their next big move. So, to bring it all together and recap the key takeaways. The fundamental picture is mixed. The powerful AI narrative is bullish, but it's being offset by significant macroeconomic and geopolitical risks. The long-term chart trend remains bullish, but we are currently testing a major resistance level after a period of high volatility. Let's go over the most important price levels one more time. All eyes are on the all-time high resistance around 673. To the downside, immediate support lies at 667, with the crucial short-term support line drawn at the recent low of 653. A break below 653 would be a clear bearish signal for the short term. So, what might happen next? Let's outline two potential unbiased scenarios. The bullish scenario, which I would give a 60% probability, would be triggered by strong earnings from big tech and a favorable CPI report. In this case, we would likely see a decisive breakout above 673, with an initial target in the 680 to 685 range. Conversely, the bearish scenario, at a 40% probability, would see a firm rejection from the 673 resistance. This could be caused by disappointing earnings or negative geopolitical news. A break below 667 would be the first warning shot, with a sustained move below 653 potentially opening the door to a deeper correction towards the 640s. The events to watch are simple. Big tech earnings and the upcoming inflation data will almost certainly dictate the next direction. That's our complete analysis for SPY today. Please remember, this is not financial advice. All information presented in this video is for educational and informational purposes only. You should always conduct your own research and consult with a certified financial professional before making any investment decisions. Thank you for watching Explain the Charts. Please hit that like button and subscribe for more content, and we'll see you in the next video.